Yeah, well, but before we get into what we've seen in July, let's just hold on what we saw for the past 2 years, because CBA really was the poster child for everything going on, and I guess confounded a lot of active managers. How did you understand what was happening with CBA? Was it a flight to safety? Was it just passive indexes buying the top of the market, or was there something else driving such an extreme valuation for CBA?
Yeah, no, it's a good question. I mean, your question is how did we understand it, which I'll take as a different question to how do we understand it, because how we understand it today with the benefit of hindsight is probably more complete than how we looked at it 2 years ago. So we owned CBA going into this, but we sold out at about $114. So way too early. Way too early. We were looking at more, hey, this thing's getting on 20 times earnings, a bit pricey. Earnings revisions won't be that big, and sold out far too early. But if I'll unpack how we see it today, how did this thing go all the way and so far? And, how does it get up to damn near 30 times earnings, which is pretty pricey? So there's a bit to this, so bear with me. First of all, is it a safety trade? Well, there's a little bit of that. When people look at CBA and the Aussie banks in general, they may say, well, this company might not grow heaps, but I don't think everyone has very strong belief that in 10, 15, 20 years' time, these companies will remain robust businesses. So pretty good stores of wealth long run. As the outlook for China's economy really slowed with the end of the property bull market. New home starts in China are down 75% from their peak a few years ago. The days of getting iron ore spending periods in $140 US or $200 US are very, very likely to be over. So people sort of realising that the best was over for iron ore and realising that the super earnings of BHP and Rio weren't likely to come back again, decided to rotate out of resources and into other things, banks being a big beneficiary, the two big barbells of the ASX. Positive earnings revisions, particularly for CBA. A lot of this, CBA is a company that consensus sort of expected to not grow at all over the last couple of years, but unwind a few bad debts, net interest margins going down, but not as badly as Fed. And, you grow at 3% per annum, not 0% per annum. And those positive earnings revisions tend to drive share price momentum more and more these days. Quantitative funds who chase earnings revisions or sell earnings misses and downgrades. And then, of course, one of the big factors, the rise of super and passive. So, super funds in Australia continue to allocate about 25% of their inflows and their funds to listed ASX securities. So, 25% of the dollar goes to the ASX 200. These days, CBA is over 10% of that index, so it's getting 2.5 cents of every dollar that goes into the super funds can go into these into CBA. So super funds own about 30% of the register of big banks. Passive will own another 25 odd percent. For most banks, the retail household sharing is about 32%, but for CBA, it's quite a bit higher, sort of into the high 40%. So you back all that out and you make an assumption that the super and passive tend to be buying most of the time. And households tend to be reluctant sellers because they're sitting on big capital gains that they don't want to sell and have to pay a capital gains tax. So they will sell, and they have sold, but it's a high threshold. You need to push the price high and higher to incentivize them to take some off. So, what are you left with? Is sort of maybe as little as 10 or 15% of CBA owned by actual active managers. So who's setting your price? Who's the marginal price setter? Well, the passive and super buying is pretty inelastic. It's there to be bought. And then as you have a reducing pool of willing sellers by active managers, the clearing price for CBA can just ratchet higher and higher, and that's what we've largely seen. One final factor, just to finish this off, is remember, partly driven by CBA, but just in general, it's been a pretty tough few years for long-only Australian active managers. And that means that they're getting outflows, and CBA, until recently, has remained their largest underweight. So you take $1 billion off an active manager and you put it into passive or in-house and super, which is fairly close to index makeup. Your biggest net bought stock is CBA, and then if CBA outperforms more, the rest of the active managers underperform more, and more money goes back to passive. So it's a bit of a doom loop there.